Hey guys, welcome to the channel Market Uncharted. In today's video we are going to look at what is a bear market, what happened in the past in previous bear markets, and how can you travel around these markets. So the S&P 500 is on the cusp of a bear market. The Nasdaq and the Russell 2000 are already there. Here's everything you need to know about bear markets. First, what is a bear market? Markets are measured from peak to trough or top to bottom. A bear market is when the closing price measures 20% lower than its most recent high. The Nasdaq has been in a bear market for several weeks now, currently sitting at around 28 to 25% drawdown. The S&P 500 briefly touched a bear market status but ended that day flat, year to date returning around 17%. On average, stock lose around 37% during the typical bear market. In contrast, stock gain around 112% in the typical bull market. So please understand, bear markets are completely normal, and usually in the last 100 years, investors can come up after that. As a matter of fact, there have been 26 bear markets since 1928 in the S&P 500. There have been 27 bull markets in the same period. The average bear market lasts only 289 days or 9.6 months, while the average bull market lasts around 2.7 years. So 3.6 years, that's the frequency of a bear market. Every 3.6 years we can see these drawdowns in the market. Of course, lately this is not what we see since the Fed and the European Central Bank keep injecting money into the market, so this is an artificial market. But before that, when we had a free market, that's what usually happened. So when you understand the likelihood of them happening, you can prepare yourself to endure them. So recently, as I was saying, this is getting less frequent, but bear markets and recessions are not always the same. There have been 26 bear markets since 1929, but only 15 recessions. Often they are tied together because of a slowing economy, but one does not mean the other is imminent. Assuming you invest for 50 years, you can expect to live through at least 14 bear markets. These can be painful times, but the important lesson is to stick to your investment plan. Here in the graph you can see since the 1930s until the 2000s how average is the bear market, how average is the bull market, the drawdowns and the profits. So don't forget, bears don't usually usually go away, but it can take up to a few years. So in this graph you see that the bear market can take a few years before starts to recover. But the cumulative still favors the bull markets. The bull markets give investors higher returns than the drawdowns presented by the bear markets. And I'm sure everyone's portfolio right now feels a bit that is going to zero or the drawdowns are big enough. But keep in mind, all bear markets come to an end eventually. Stocks are positive 78% of the time. So the idea is try to stay invested in high quality dividend stocks, prefer defensive sectors such as pharmaceuticals. Keep dollar cost averaging into your index funds with the idea of 30-40 years old. Dividend funds also good because passive income always help on a drawdown when we have a recession. And don't let the fear set in. Also look to stores of value such as precious metals or other sectors that provide good recession or can have good results during a recession. So thank you guys so much for watching this video. Never forget, knowledge is not power, knowledge is potential power, execution is everything. And just like the markets, we will not rest.